I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by President and Head of Portfolio Strategy, Nicholas Bohnsack. Nicholas, how are you doing today?
I'm doing great, Ross. It's good to see you, my friend.
Good to see you as well. I want to do kind of a grab bag, 30,000 foot view here. Let's start with the Fed. It's been in the news. I wonder how you're handicapping the odds of a cut at the September meeting, and then just more generally how you're thinking about all of the action that's happened at the Fed and between the Fed and the White House over the last few months.
Yeah, let's start with that last piece, Ross. I think if there's anything that Secretary Besson has done particularly well to a point, is to try and keep the president sort of out of the Fed's business. And I thought he did that, as we may have talked about earlier this year, somewhat adeptly by having the president focus on the long end of the curve. But as we moved into June and through July and now August, the president couldn't help himself. And so the political pressure on the Fed has been particularly acute, I would say, for our clients and market participants alike. What is better is that the data are starting to come sort of in support of a Fed cut. So irrespective of your political view on the situation, certainly between the inflation data and the earnings data and the payroll, labor data, it certainly is suggestive that the Fed will move in September, as you mentioned. Whether it's 25 basis points or 50 basis points, the Secretary of the Treasury had made mention, which was somewhat out of character for both the man and the position, to talk about a potential Fed cut, at 50 basis points. The market is really suggesting that the Fed will come with a cut. And we have to view that as bullish, I think, for risk assets in general and also for the curve in particular.
Yeah, the market has definitely liked this rate cut optimism. Some of the rate sensitive sectors popping here, home builders notably. One other thing that stands in support of the market here, which again is kind of flirting with all time highs, is the earnings backdrop, the fundamental backdrop. We're kind of closing an earnings season here. What's been your big kind of high level takeaway from this earnings season? What have you liked?
Well, one word, it's resilience. I think, if we all think back to those early days of April, the market's reaction to what I guess is being described as Liberation Day related to the tariff structure, tariff scaffolding from the administration, and then just what ensued over the coming weeks. I don't know that anybody would have thought, certainly we didn't think that, you could go through the 2Q reporting season when it was all said and done and see corporate profits up 11%. And not only is that a pretty robust number sequentially from what was a very strong first quarter at 14%, but just given sort of the degradation to the outlook that ensued from the tariff rollout, a very, very strong recovery. So resilience from a broad swath of corporate operators on the profit side. And then I think looking forward, which is always important when we talk about earnings, is that you saw as much as a little bit more than $3 of recovery to the aggregate earnings number, the aggregate earnings per share expectation for the S&P 500 for the total of 2025. So now you've got a consensus number that's closer to 267, 268. That's a very strong denominator. It certainly is helpful when you consider valuation. So if you couple, as we talked about a moment ago, the potential for lower Fed rates, you bring in the fundamentals, which are sort of following through and reaccelerating from a point of uncertainty. There's not a lot to get, overly worried about when you look through earnings season into the second half of the year.
Well, and as we talk about that, some of the things buoying markets higher, again at or near all time price highs, sentiment or exuberance about this bull market then starts to become, a risk that investors have to take into consideration. How are you feeling at this moment in time about the sentiment backdrop? How are you feeling internally, and what do you do with that sort of data?
Yeah, so I'd say when it comes to all of that, and you lay it out very well, that would be the one thing right now standing here, short of some, exogenous tweet, from left field that does make us a little bit nervous, both internally at Strategas and then generally when we run around and chat with clients, is that everyone seems to be pretty optimistic for certainly the capital markets and then also, and importantly, the economy as you look out towards year end. I think it's true that there are some special lifts when you consider that the specifics of the tax bill, and then generally the way that the tariffs have come to fruition and the tariff negotiations have played out. that we don't get overly worked up. Sometimes sentiment is a good thing. Positive sentiment is a good thing, and there is some room for the market to run a little bit higher, but it will continue to have to be proved out by strong corporate profits. So the one thing about the second quarter growth, to just go back to that point, which I think has fueled sentiment, is that was there any pull forward in activity into 2Q in the anticipation that the operating environment could be more punitive on the import side in the third or fourth quarter? That remains to be seen. I think the early look at 3Q is okay, so probably supportive of higher prices. But to your point, Ross, and a good one, if we want to be on the lookout for exuberance on the sentiment side, thus far not yet, but certainly on the list of things that we want to keep in mind.
Yeah, it's a dicey one. You need bulls for a bull market, but too much often signals the top. So this has been awesome. Thank you so much for the time, for the insight, and we'll look forward to talking to you again soon.
Yeah, appreciate you, Ross. Look forward to talking again.